Hello, friends. Once again, I welcome you back. So, today I want us to talk about order blocks, and these are the main things that I'm going to be addressing. And in today's example, we are going to use VIX 50, 1S, boom and crash, and NAS 100. Why have I listed these ones? It is to show you that you can apply the concept even other assets. So, it's not the first time that I'm talking about order blocks, but I believe I'm going to bring on some new ways or sometimes revised ways of how I deal with order blocks. So basically, in one of the things that I've come to understand, order blocks are, are a type of supply and demand, but they are a little bit different from supply and demand, though they are somehow similar, like supply and demand zones, anyways, but they are a type. They are a type, and hopefully, even in upcoming episodes, we shall be uh, understanding this more. So, if I'm to start by explaining, the main reason that I'm doing this is that I want to explain why I think the market moves as it makes pullbacks like that. You get? Because normally this is what we are finding on the charts. And then when we try to find reasons as to why they are coming, and then maybe why they're moving and breaking above, possibly it could help us, it could impact on us determining market direction, because we all come with the expectation that we can determine where the market is going, the direction of the market. Basically, that's what we come on the charts thinking that we can pretty determine. So given that this is not gambling, we have to have reasons. So using this simple illustration that I'm having just down over here now, uh, there is a saying that market makers sell to buy and they buy to sell. Putting this aside, for a selling market, uh, this is something that would expect, because this is the behavior: sell, uh, retracement impulse, like that. So which means in a selling market, they buy to sell. So there comes these areas, these retracements. Let me highlight this retracement area, this area over there. You get? Before we got the impulse that came down, and then this other one that you're seeing over here. You get? So these areas where the market retraced, sometimes this is where the concept of order block comes in. You get? The concept of order block comes in. Now, there are those moments, you get? There are those moments. This area here, it could be an order block itself, you get? Because overall, we are selling. Why all of a sudden would you buy? You get? So which means uh, along the way, you get? Along the way, let's say for this part where we got the impulse, by the way, let me quickly illustrate here. Actually, I've found out another way of explaining this. Now, along the way of us making this impulse run, you get this impulse run, it has to break a market structure. Let me hope you guys I'm not confusing you, because I hate confusing someone. Now, we broke structure there, and then we had this impulse run that broke structure. Now, along this path, we could have some bullish ranges. You get? Some bullish, let's say bullish candles that are going up. You get? So now, which means the market, you get? Sometimes the market comes, you get, to pick up orders. So the concept of order blocks, we believe that those moments when the market maker, as they're moving along this path that is coming, they leave certain orders behind. You get? They leave certain orders behind. You get? So now, uh, that's it. Now, when we go on the charts, I think it will be a little bit more clear. Let me first delete. You get? So now, if we are to go back, first of all, we can see that in both scenarios, for the bearish, we have a break of structure. You get? So for me to validate another block, it is always good that there is a break of structure. But it is not that when there is no break of structure, there cannot be another block. No, it is possible for us to have another block when there is no break of structure. You get? So this is kind of controversial depending on the let's say the type of trader that you are. Just like sometimes, just imagine, let's say there is a movement. There is a movement. Let me look out here. There are those moments. Let's say the market comes and that then it doesn't close. Uh, yes, let's say this area here. Let me hope you see it. You can see that this candle just went above, you get, but it didn't close above, you get. There was just a sweep. So someone could call this a break of structure. Personally, I don't normally validate this as a break of structure, and for me, I would validate this red one, because we moved and then we can see we even have candles that closed above, you get. So for me, I would call that a break of structure. So some things you may find that on certain channels they are addressing them differently, but what matters most is the reason that they are giving, you get, the reason that are giving. So now, what we normally realize that when we break structure, and now we have displacement. By displacement, I talked about displacement a little while ago. It means that now the market maker is willing to leave the area. Now, displacement areas like here, you get this impulse run that you're seeing. This impulse run that you're seeing. So there, we can say there was displacement here in the market. The market maker was leaving this area, you get. And normally in the displacement phase, we can leave some imbalances, you get. We can leave like the market doesn't normally get balanced, you get, because we see that they are willing to leave this area to this area, you get, to that area. But now we want to be you guys, you'll forgive me. Anyways, now we want to be determining what are the reasons behind this displacement, or how can we catch these displacements for us to be part, you get. So for me, my main interest is in helping you determine how you can be part of this displacement as it's forming, you get. That's why I highlighted this area here, and I'm going to explain why, you get. So let me hope the video doesn't get long, but I'll try to make it short anyways. So now uh, we've seen there is a break of structure, let's say for the bearish case, and then we are seeing displacement. So which means we break structure and then we proceed down, you get. So now what really comes to our minds is that given that the market is willing to proceed down, as we are returning, this is a retracement. It means that overall the market is selling, you get. You get? So now they buy to sell, because overall, I told you the market makers have the money to move the market. So which means here they are buying, but overall their interest is in selling. So that's why some people say market makers buy to sell. That's why if at all the market now turns bullish, these areas here become our points of interest. Sometimes we can be highlighting these areas where at first they were buying, you get, to sell. You get? That's why always order blocks, we call them opposite candles, you get. If at all it's a bullish order block, for instance, and there is now for this case here, uh when there is a break of structure, but a break of structure here, you get. So the last opposite candle, personally I like validating full bodied candles, you get. We could say that um possibly this area here. Sometimes if at all it's a consolidation, I normally highlight almost the whole zone, you get. I can say that in this area, all the selling that was happening here, they were manipulating the market because their interest was in buying. What does it mean? It means that they could be returning to that area, you get. Now it comes in this concept. What I'm interested in is are the pending orders, because it's easy to spot displacement, you get. It's easy to spot displacement, this displacement. But now the main interest as to why I brought in this are the pending orders, you get. Yes, we are going to see the order blocks. Sometimes the market returns to them and sometimes it doesn't. So now pending orders call for mitigation. Now this is it. when the market is coming down, you get, and then along the way, let's say they have a million shares, that a million positions that they're taking, you get, they may first activate 700, you get, 700, and then they will be remaining with more 300 million, you get. So they can return to this area here where they left those 300 million, you get, they can return to that area, and now they sell because their interest is in selling. Now, what does it mean? It means that sometimes they sell and they leave no money. You get, they can activate all their orders and then they move. You get, and now what do we know? How can we determine that they've left no orders? Now, let me tell it to you straight away. It brings in even the entry models. Now, there are those moments, let's say, when there is a break of structure, as you can see, and now we get sometimes a consolidation, not always, but most times we get a consolidation and then we move. Remember, we got a break of structure here, we broke structure. Now we can see that maybe our sellers are in control, but now what can help us to determine that there are no orders left is a consolidation or a creation of a range. In most cases, we can just determine just a little bit here. Here we can bring in the concept of liquidity. They may just sweep liquidity and then they proceed down. You get, it's unfortunate that my battery is running low. So now let me delete this and then I quickly go to the examples, because if at all I continue bringing the theory, it may confuse. It may confuse, and I don't want to confuse you guys. You get? So now, anyways, let me delete this one as the last one. So now, what I was saying. So now we are going to come here on the chart. You get? We are going to come here on the chart. Now, if you can see here, we had a range. We have this range that you're seeing, this top here and this bottom here. You get this bottom here. So now we can see that there is a break of structure here. You get? Now we have this bullish candle, the last bullish candle. Now we can possibly determine that this is our demand zone or our order block. You get, the last opposite candle, because it's relatively big. And actually for the order block, we can see that we have these candles that were moving, this imbalance that was going up. You get, this imbalance that was going up. Now in this imbalance that was going up, the topmost candle that is relatively big, most of the time I like it full bodied. uh Actually, sometimes we validate that as the order block. You get, that candle. So as you're validating order blocks, mainly be interested in those large candles. You get, so it's a large candle. So now you go on refining. So maybe refining, I'll bring on another episode. So you can comment down below if you're interested in that refining part, because it might be long. So now this is the area. Now, as we are moving, you get, as we are moving, we break structure. You get, remember, by the way, this is volatility 20, volatility 50, 1S on the H1. You get, so now it brings in even the concepts of order flow, anyways. So now, as we move up, you get, as we break structure, now on M15, you can be looking for buying opportunities. What are you waiting for? You're waiting to look at this area here. You get, this area here, how the market is going to react. Now, this one becomes our area of supply. You get, so now when we reach in this area, there are two things that could happen. You get, because we know the market moves like this. There are two things that could happen. It's a possibility that the market will come and then it breaks above. You get, or it is also a possibility that the market will move up here and then it drops to continue the bearish move. You get, those are all possibilities. But now, nonetheless, for us, we know, at least if at all you were buying, you bought up to this area and then you watch the market. What happened? The market reached it and then returned. You get, now we can see that the market only reacted to this fair value gap. You get, so now let me quickly rush through this. We reacted to this fair value gap, so which means we are going to be highlighting even fair value gaps as we go on. You get? So we had 2 points of interest down here. Actually, three. I'm going to explain all of them. You get? We had a fair value gap. You get? We had a fair value gap because overall the market had turned bullish. You get? Now, as we are returning, there are those points that you watch, you get, more so on small time frames. Now, I told you sometimes fair value gaps are good on pullbacks. You get, on pullbacks, when we get a reversal in a fair value gap, then most times we are proceeding up. You get? So now this was one of the points of interest, the order block here and then down here. You get? Because this was the last fully boarded candle before we got a break of market structure. But then we broke structure, and then there was displacement also, and then we got displacement anyway. We left this area to go up here. You get? So we have to determine. Now, one of the things that can help us to understand where the market makers left orders behind is the quickness of returning to that area. You get? The quickness of returning to that area. Now, when the market maker, now, when we reached here, you get, when we reached this place here, you get, when we reached this place here, and now the market quickly returned, you get, but then it never reached here. So it can help us determine that there were no pending orders left. The returning, it is called that's what we call mitigation, you get. So now there were no orders left behind, you get. So we just stand here and then we proceeded up. Now, given that, now this is the point that I wanted to explain. So given that there are no orders that were left here, you get. Now, even this return that broke structure here, you can see that we moved and broke structure above there. You get? Us returning, one of the points that we'd be looking out for, you get, one of the points that we'd be looking out for are these fair value gaps. You get? At this fair value gap. So the market just came, tapped into this fair value gap, and then moved up. That's why it would be a little bit risky, though it was possible. It was a little bit risky for you to think that we're coming, let's say, to come down here. You get? So why would I target this fair value gap? Because I know this area, there were no orders left. Now, the next time that we are coming, I even expect that we are going to be passing there. You get? So now I believe it's a little bit complicated, but now let me go on I think MT5 here on volatility 51s on M15. You get? Now we have already our bias that we are bullish anyways. You get? Overall we are bullish. And now I want to just show you, because you can even do this analysis on M15. You get? On M15. I'm only rushing because my battery is going down. So now when you come on the chart, you get, we can see that some of the things that I normally do is noting out the recent breaks of structure. You get, we can see that we broke structure. Now what do we expect is a going down and then a return. You get? Now when we returned, you get, as we got this opposite break of structure, you get, we create a range. There's a time I told you about creating a range. So this point here and this point here become our points that we look at. You get? But in between these points that you're seeing, these points, let me delete this one. In between these points that you're seeing, you get? Those points that you're seeing, we look out for order blocks. You get? All demand zones. So you can see that before we broke the structure, we have this range here that was created. If at all the market surpassed this area here and went above, then we could say supply is not holding. You get? So now, given that we returned quickly, in most cases, it is a sign that there were orders that were left here. You get? So it is a sign that orders were left, and then they come and pick them, and then they proceed down. You get? And then we broke down here. You get? So let me go on a crash. I think I'll do part 2 of this because I've rushed a little bit. So now we can see, you can see that here we broke structure. You get? We broke structure, and now just down here we can see that we have these large candles that were moving down here. You get? And then we broke, there was some structure that was broken here. You get? So the moment the market returns very fast after a break of structure, if it returns very fast, You get? It is one of the signs that orders were left. You get? But then if the market leaves and then it proceeds, let's say, as you can see here, you get, in this area here, first look, we broke structure there and then the market moved. You get? Now, given that it moved a very long distance and it even consolidated without returning, without returning back immediately, you get? It is a sign that there were no orders that were left here. You get? There were no orders that were left here. But if at all we break structure, this small structure that you're seeing here, and then the market returns quickly, it is one of the signs that there were orders that were left behind. So this one becomes a valid demand zone. You get? So each moment the market is coming in this zone, it is likely to be buying. If I can put it simply, that's what I wanted to explain. So sometimes you look forwards to describe what you want and it's really hard. So what I wanted to explain is that how do you validate a demand zone? You get? But then using order blocks. Order blocks are those opposite candles that are running before we break structure. You get? So the moment we return back quickly to that zone, it validates that zone. That's why you see that each moment we were coming here, you get? Each moment we were returning here, the market was leaving impulsively. You get? So here you take risk entries and then you buy. You get? And now for for NAS 100, when you come on NAS 100, it normally happens because sometimes for it makes double moves. It goes, let's say New York today, it goes down, the next day it goes up, the next day it comes down, the next day it goes up. You get? So you can see that we break structure, they leave orders here, they come during line and they pick them up just like today, and then they move down. You get? So if at all you're interested in this, you leave a comment down below for me to make part 2 of it and be more elaborate. If you've understood, please like the video. And lastly, you can join my boot camp that I'm starting on the I think I'll start it on the 10th of January 2023. I don't know when you'll be watching this video. So you can join my boot camp where I'm going to be sharing the first one. It's going to be for sharing BTMM. You get BTMM, where we can apply BTMM concepts to volatility indices and even Forex, but majorly applying it to volatility indices. Basically, we are going to be using these for moving averages. You get? So it looks like this. So I'm going to be explaining that. And then after that 1 week boot camp, I'll start an 8-day boot camp in advanced price action, where I'll be mainly talking about these concepts. This is SMC and ICT concepts, blending them together with BTMM for the last days. You get? So the first 5 days will be for price action, and then the last 3 days will be for BTMM, for those that will be part of the 8-day bootcamp. So for the 8-day bootcamp, we shall be talking about flipping small accounts, psychology, and a lot. So you can join. For now, I wish you the best and peace.